All right. Welcome, Evan Curtis, to the Self-Employment Success Podcast. We're excited to have you here today.
Thanks, Leland. Appreciate you having me on.
Yeah. Evan, I'm excited for you to be here to hear both your kind of story as well as to dive into your expertise in real estate and that as an awesome entrepreneurial opportunity and investment opportunity just in general. But let's start off. Why don't you tell the listeners about yourself, who you are, where you're located, and kind of your story of kind of where you've landed today and where you are today.
Sure. Happy to do that. So my story is based in Southern California, where I am currently located. And I have been in the finance and real estate space for roughly 19 years now. Started my career at a company called PIMCO, out headquartered in Newport Beach. Did a couple roles across my 12-year experience there. So kind of in the fixed income multi-strat account management side for half the time, and half the time on the product side, focusing on private equity and hedge fund real estate related products. So was really fortunate kind of somewhat early in my career to be able to be on teams that were raising multi-billion-dollar funds and deploying it across a very diverse mandate, public, private, debt, and equity, US and Europe. And, that really helped kind of set a foundation of understanding all the various pieces of real estate and how dislocations can happen in one space that impact other areas that may be unintended consequences. So had a really good time at PIMCO and starting my career, and worked with a ton of really smart people. Moved over to another company that was a diversified residential real estate company that kind of had a few different areas. I was leading the investor relations function there, where we were managing roughly 200 million in funds. But I was also part of the commercial multifamily value add team. We were acquiring assets in Dallas, Fort Worth. So we acquired roughly 2,500 units over about a 5-year period there. And, it was really interesting to be able to help kind of build that portfolio from the ground up on a very small team, but with strong support from other individuals across the firm. So, I was always kind of making my way further and further in towards the real estate space to ultimately kind of do something on my own or join a much smaller firm, and was kind of waiting for the right market opportunity as well as personal circumstances to line up. And, it's always the combination of those two lining up, which seems to make things difficult. But, I felt the time was right at early 2023, late 2022, when we had seen kind of a clear inflection point as far as valuations in the real estate market. So that the market opportunity section was lining up for me. And I think on the personal side, it's always just a leap of faith to go to a much more entrepreneurial space. So moved to Vanamor, a company that was founded in 2017 by a friend named Bobby Larson, who I worked with at PIMCO a long time ago when we were there together. And Vanamor is in the multifamily value add space, and similar to what I was doing at my company prior to joining, we are acquiring assets that are middle market. So we define middle market between, call it 10 and 50 million in size. We have a geographic focus that is, if you think of an L shape on the West Coast, it's Pacific Northwest down to California and across to Texas plus Florida. So pretty broad base that we're looking at. So largely kind of primary and secondary markets. We really like suburbs more than kind of CBD locations, but focused on kind of 5 to 7 year hold period is what we're looking to acquire. Good kind of cash flow going in, combined with kind of appreciation through a value add strategy to get to what we think is a good, attractive kind of risk return profile from the deal.
Okay, so you started off back at PIMCO, which for listeners is a huge investment company, and many of you can open up your investment portfolio, look at it, and see PIMCO funds in there. They do a lot of different things, but you started off kind of in their fixed income world and transitioned over to their real estate area where you got a lot of experience building like real estate portfolios, I'm assuming, and for their PIMCO investments. Is that correct?
That's right.
Just making sure I understand that. Okay. And then transitioned over to a larger firm where you're kind of doing similar to what you're doing now, working with purchasing multifamily units. So a lot of this, just for listener translation, is purchasing, I will say, like multifamily units being like apartment complexes or mixed use where, there's stores down below, but up top are, residential living spaces. And value add being like we rehabilitate them, we kind of bring them back to life, and then rent them to create the cash flow and either eventually sell it or maintain it. Is that just for listeners to understand from layman's term role? Is that kind of what that looks like?
That's more or less right. Thanks
Okay.
for, translating some of my jargon that I
It's okay.
use.
It's fascinating and a huge world. And so then I feel like I hear this a lot from entrepreneurs, is this idea of like, I'm ready for a transition, but a handful of things need to line up both professionally and personally. Timing is always really important and stressful when you're like, I want to make a change, but either professionally it makes sense, but personally it doesn't, or personally it makes sense, but professionally it doesn't. But the stars aligned a little over a year ago, I believe, like kind of you said, it was late 2022, early 2023. And you were able to make the jump to join a colleague of yours at Vanamor, where you are now, that does a lot of that same work, but kind of in that L-shaped middle market range, like suburban areas, kind of in that West Coast and South, including Florida. So
That's right.
there's so much to talk through there of like going from a big corporate setting into a small team setting, no matter what industry you're in. That is a whole different world. You're taking on different responsibilities, a lot more pressure kind of falls on you. You do end up, whether you're the founder or not, you do take on much more entrepreneurial roles just naturally. Like when I left my corporate job, I'm serving clients still. Like what I'm doing day to day hasn't, I mean, it's changed, but not a ton. But going from corporate to, it's me and my team, that's a big change. So what's that experience been like for you? You had the real estate expertise already. Now you're in just a different environment with it, but it's a pretty stark difference going from large to small. We're in startup mode.
Very, very stark, I would say, is a good description. It's, we're Vanamore is a 3-person team. So we are small, to say the least. And, it's a very much eat what you kill environment. So, we're all out there trying to kind of find the deals that make sense. Once we do find a deal, we're out there looking to, speak to our network of potential investors to invest alongside of us in those deals. And then once we acquire the deals, we kind of split, execution of the business plan, of the value add business plan. So it's very much wearing all the different hats, which, luckily all of us have kind of been in that space for a long period of time. But, having the sole responsibility of stewarding kind of the financial interests of your network, as well as, making sure that the asset performs kind of how you want it, and managing all that is, it's a big responsibility, like you said. And it's been, one of the things that I think has been the coolest about making the transition is I'm talking to a lot of folks like yourself and, various other entrepreneurs that I've always had kind of a very healthy respect for entrepreneurs, but, I didn't quite get the full impact until I've, moved over to a much more entrepreneurial role, and kind of speaking about it with other folks, and their willingness to help and openness on kind of supporting other entrepreneurs has been a very positive impact and feedback I've gotten so far. So that's been really nice to see. The other one point that's worth pointing out that I think is vastly different from kind of the corporate space that I was in is, now I'm doing podcasts. I wasn't doing podcasts before. I wasn't really kind of trying to really grow the brand. I was more on kind of the product side versus the marketing and bringing more eyeballs into the company side. So moving into that space more and focusing a lot more of my time there. I was more tangentially involved on that side previously, whereas now it's one of the key components of making the kind of the company successful. So that's another big shift.
Totally. I love what you said about entrepreneurs with kind of the help other entrepreneurs out. That's been my experience too. And we've talked about that in other episodes of this podcast with other guests, where sometimes you're in corporate settings. This was my experience to an extent, where it's kind of like, hey, I have the secret sauce, but I can't share that with you because you might encroach and take my clients or take away my opportunity. And it feels much more competitive and much more scarcity, where there's not enough to go around. So if I have the secret sauce or something's working for me, I should be careful who or how I share it. But what I found moving into the entrepreneurial world is there's so much more of an abundance mindset. And maybe that's just the function of, when you're an entrepreneur, you're dreaming, you're thinking the world is much bigger. But, and also just the empathy of like, we've all suffered through, the struggles of entrepreneurship. So if something's working, we're like, hey, I found the way out of the burning building. Let me tell you where the door is. But it does feel like there's this scarcity versus abundance. And when you taste the abundance, it's like, oh my gosh, where has this been? This is awesome. People are so generous with their time, with their expertise, which is really, just a wonderful thing, like just a weird phenomenon. And the second piece is the wearing multiple hats. Similarly, at my last firm, I had to go find new business, but I wasn't really worried about building the brand of my company or anything like that. Now I'm, hosting podcasts and building brand and, and serving my clients. And so it's like, okay, I used to have 2 or 3 plates spinning. Now I've got 10 plates spinning, and some of them I don't have a muscle for, or I've had to develop that muscle over time, which, is a new stark difference. So I think both of those are true to kind of the universal entrepreneurial experience. So you mentioned making the jump to Vanamor, happened at a unique time personally, but also professionally because of kind of the nature of the real estate market. And you're significantly an expert in real estate at this point, which is fun to be an expert. But I think in my experience, I find that things like social media, TikTok they're like the bane of financial education. It's just a lot of like clickbaity things that like have half truths in them. And for me and my clients, I love talking about real estate. I love investing in it. It's a great asset class, and it's an asset class that a lot of financial advisors don't typically jump into because, it takes away from their own compensation. So that's, a conflict of interest there. But it's become a bigger and bigger piece of the pie because it is an incredible investment opportunity, entrepreneurial opportunity. People have their whole lives just on real estate investment and treating it like a business, or people have their business or their jobs and also invest in real estate. So it's wonderful for so many aspects. But I'm curious to hear your thoughts on why 2022 to 2023, why now is a unique environment for real estate.
Yeah. One thing before I answer that one is, so I don't have a TikTok, so maybe I'm missing out there, but it's a fine line to walk too. So, Vanamor and kind of the 3 of us who are part of the team, we're very much not that kind of clickbaity, 5-second clips on how to get rich on real estate group. We're much more kind of institutional background. We like kind of understanding the macro environment and how that impacts ultimately the micro or the property level. And, speaking with folks who are very, very understanding that real estate is generally a long-term game. It's a get rich over the long term, much more than some other folks kind of make it out to believe in a lot of areas. So, anyways, you won't find a TikTok from me, at least.
I appreciate it. Maybe you need one to put out actual good education out there. Who knows? But I'm with you. It's about kind of deep evidence education, and good investments are long investments. That's my 2 cents, but I want to hear you talk more.
Yeah, no, that's a good 2 cents. So, yeah, it's a very interesting time in the real estate market, and kind of ties in with why I made the move to Vanamor when I did, which was, I was waiting for a really big piece of the puzzle, was the market opportunity to make sense, to move to a smaller firm, and ultimately be in the right kind of place at the right time to very responsibly grow a portfolio with the right cost basis over kind of a 5 to 7 year portfolio hold period. And when the Fed started raising interest rates aggressively in mid 2022, there were significant impacts to real estate from that. And everybody probably knows, since the GFC in 2008 timeframe, real estate really took a big hit, and then pretty much has been going up ever since then. There was a very brief drop on valuations from COVID, but post COVID, it parabolically went up, kind of to the opposite of what a lot of people would have thought. So, you had an asset class that had been going up for a very long period of time, and now the Fed doing what it had done caused a clear and significant impact to valuations of real estate. And real estate has been kind of in a downtrend since mid 2022, where transaction volume has been roughly 70% down, kind of from prior year transaction volume. And you're seeing a market environment where assets are valued 20 to 40% below where kind of that peak pricing in late 2021, early 2022 was. And a lot of people don't really realize that. So I've been having a number of conversations with people outside of the real estate industry that have kind of context of real estate in the form of what's happening in the single family home market. They own a primary home, and they follow very closely what valuations are on the single family side. And what we're seeing on the single family side is there hasn't been much of a pullback at all. There's a number of different dynamics that cause the reasons for that, but there hasn't really been a pullback. So a lot of people don't really realize the magnitude of the drawdown from peak pricing that we've seen on the multifamily side, and commercial generally as well. A lot of people know what's going on in office, and it makes a lot of sense, but kind of commercial real estate in general has taken a very large pullback from where it was. And then you couple on top of that the other kind of main street point that people follow from a financial markets perspective is public equity indices are at or near all-time highs. We're in February right now, and the S&P 500 just hit over 5,000, and that's the first time it's ever been at that level. And so you have this very interesting dynamic with certain risk asset classes at or near all-time highs, and then real estate at 20 to 40% below peak pricing. So now I think is the time for folks who have been wanting to kind of get knowledgeable on the space and potentially grow their portfolio, diversify their portfolio in a very tax efficient manner. We didn't talk about kind of some of the other benefits of real estate, but now is the time, in my opinion, to start paying attention and really kind of get educated on the space if you want to get involved.
I completely agree. And Warren Buffett, who's like kind of the famous investor, says when everybody's running towards something, run away from it. When everyone's running away from something, run towards it. Because when everyone's running towards something, that's clearly a sign that it's about to be overvalued, and then it's going to bust. And no one has a crystal ball, but yeah, the stock market has hit all-time highs. People are feeling consumer sentiment is much more bullish on the market than it's ever been. And real estate has cooled. When interest rates go up, it's harder to get into real estate. And so it slows things down. And you're right. I think people, when they think of real estate, think mostly of their primary residence or maybe office buildings because of, where they work, or big news outlets like talking about WeWork and things like that. It kind of gets a little bit more headlines rather than like multifamily and those investments. And so seeing whenever a sector is significantly down, but it's a solid sector, now it's a time to really pay attention, because that's probably the most opportune time to get in. And like you said, whether it's real estate or, equity stocks, we want to buy low. You want to put your money in when it's down, because it's going to go up, and because you're going to get more bang for your buck. You're going to be able to purchase more when it's, if you buy more on Black Friday than you do, any other time when stores are expensive. So yeah, it's interesting. I'm with you that now is the time. If you're considering real estate investment, it's a wonderful opportunity, because it's also not getting huge headlines. Like, I feel like real estate that's getting big headlines are the realtor law changes or things like that, not as much changes to actual valuation there, or interest rates on, primary residences are getting headlines. But we kind of have this whole part of it that's a wonderful investment. Like you said, there's tax advantages to it. We can talk about that if you want. But now is a really opportune time for that, just because of the unique nature of it. And it's interesting when you think back, like you said, real estate's always going to be a solid investment. It's, a finite resource. There's only so much of it. But we had the global financial crisis in 2008, and people don't realize that was pretty short. Valuations fell naturally because the whole market burst. But then from then on, it was, a decade plus of really strong growth into, 2020. It grew a ton. And then when everything was overpriced and inflation was skyrocketing and the Fed increased interest rates, it's really the first time we've seen a cool down in the real estate world for quite some time. And so now could be the great opportunity to jump in when most people are moving away from real estate, because they're moving towards the market. Most consumers are 3 steps behind what's actually a good investment.
It's a big statement, but I think it's a factual statement. This is the largest dislocation in real estate we've seen since the Great Financial Crisis, and it's not on kind of top of mind for a lot of people. And investor psychology is such an interesting thing for a lot of the reasons you touched on. Late in 2021, people couldn't throw enough money at some of these real estate deals that were at historically tight cap rates. And cap rates are, a way that properties are valued through kind of the value of the property and the net operating income of the asset. And, cap rates have moved significantly from those really kind of historic tight levels of, call it 3.5% to 4% cap rates in a lot of environments, to now we're seeing, 5.5% to 6% cap rates on those same assets. And you see a lot of people like, I'm not too sure if 5.5, 6 cap rate, I want it to go up to a 7 cap rate. Whereas a lot of those same groups were the same ones that were buying 3.5 cap rates, a year, 2 years ago. So there's so many things that you can unpack, and kind of what's led to the situation that we're in, and, potential further down. I mean, you could very easily make the case for further downward movement, though. So I fully understand that, there could be more negative valuation to be had in the future. So there's a lot of short-term challenges in the real estate market right now, but multifamily specifically. But I think from a risk reward perspective and kind of an understanding of analysis, you're in a heck of a lot better place now than you have been in any other recent period.
And like you said, the idea with these things is they're not get rich quick schemes, which people make it out to sound like it is. These are longer term investments. These are investments where we're putting money in and we are playing the long game here. And so, will the market hit another all-time high this year? I don't know. Maybe they hit like 17 all-time highs in 2020, 2021. And so, like, in the stock market side. And so, but we know there's going to be short-term volatility. But what we're seeing, like you said, is a unique dislocation in this multifamily real estate world, at least in the short to moderate term. So it's a good time to be thinking about it. Expand a little bit on the tax benefits to people who invest in multifamily real estate.
Yeah, tax laws is very favorable to real estate owners, and one of the biggest pieces of that is the fact that depreciation is a very large expense that's afforded to real estate investors. It's a paper loss. So you can depreciate an asset based on a certain kind of schedule or a useful life of that asset, and you can use that depreciation expense to offset income that's generated from the property, and ultimately kind of reduce your taxable income come K1 time or annual tax reporting time. So in many cases, you're able to defer all of kind of income that's generated throughout the life of an asset. Granted, if you sell that asset, you have to be mindful of capital gains and depreciation recapture at that point. But it's a very effective tool to defer taxes throughout the hold period of an asset. And as you and most listeners, I'm sure, know that we are benefited by kind of deferring taxes, and having more money today is better than having less money and paying the taxes today, generally. So you also have one of the other big pieces of this that is still in play right now is there's bonus depreciation or accelerated depreciation that is stepping down right now. So right now it's at 60% for 2024, but there is some rumors and chatter and potential that 100% accelerated depreciation comes back to the market. And what that allows is investors that acquire an asset, they can do a cost segregation study. And what that does is it really lets you pull forward a lot of depreciation in year one, and you take a very outsized loss on year one for your tax reporting. And you can use that loss if you have gains in other areas of your kind of financial circumstances. So, it's very beneficial for folks who have cash flowing and other real estate gains to then acquire properties and do a cost segregation study, and kind of really helped increase the transaction volume. Hard to put kind of specific statistics to it, but very impactful for some of the larger portfolio folks out there.
Yeah. So what you're saying is, depreciation is the idea that when we buy something, certain assets, the cost of buying that we can write as a deduction in certain percentages over time. The IRS gives us a schedule or a calendar of, over this many years, you can take a certain portion of the cost of this property and depreciate it, meaning use that as a deduction against your income from that property. But then there's bonus depreciation, which says up front, you can do more of that. So like you said, it's been going down. It used to be 100% for a few years, meaning you buy a property, 100% of the cost you can depreciate right up front. Now, the last year was 80%, this year it's 60%. And you're right, there's some legislation that has not officially passed, and we don't know if it will, but the rumor is it could, that will bring back that 100%. So the idea, like you're saying, is, hey, if I have these other properties that are cash flowing, that I own, that are making me income, and I buy this other property, I can do something called a cost segregation study and say, okay, well, I've got I can depreciate the cost of this building. I can file a loss on it, and that loss can be used to offset the income from these other properties, which is a lot of tax planning mumbo jumbo. But what it does is, on paper, you just bought a property, and now because of that cost, you can avoid taxes or defer taxes on the income from these other properties. And it does get complicated, like you said, when you sell properties, anything you've depreciated, you have to recapture, meaning you then have to pay the taxes on it. So it's complicated. I don't want listeners to go around just now spouting off half truths about depreciation, but it's a legitimate strategy that a lot of people use and is really, really powerful from a tax perspective. Real estate, whether it's a passive investment for you or an active, it's your job to do it, has a lot of opportunity in the tax code. The IRS does value real estate investment and provides a lot of opportunity, which is why it makes it such a great diversification tool inside people's either business portfolio, personal portfolio, which is why I wanted to have you on here. Is real estate is really powerful, and I want people to know it and to know, this is something we should be looking at, whether throughout time. If your financial planner, your financial advisor is not bringing up real estate, they might not be fully thinking about your best interest because it's a huge opportunity for many people. So
I agree.
So what's next for you as you're kind of navigating Vanamor? What's Vanamor hoping to accomplish? Where are you guys going over the next year, 2 years, 3 years? What's your hope?
Yeah, we only closed one deal in the last 18 months. I mean, it's been really difficult to make something or have a deal that makes sense. There's been this period of gap between where buyers and sellers are to kind of ultimately transact. And, sellers have been kind of adjusting their pricing to be more realistic with where buyers think market valuations are going to be. But it's been a pretty slow and somewhat frustrating path, down there. And, we're a lot closer now than we were kind of mid 2023. So we're underwriting a lot of deals. We really like markets in the Sun Belt that have experienced and continue to experience kind of strong population migration growth. So, Phoenix, for example, major markets in Texas, those markets have been hit probably the hardest. And back to your kind of Warren Buffett comment, those markets are starting to look very interesting to us because there's a lot of short-term or near-term kind of potential pain that's coming and happening right now. Like supply, for example, is one of the biggest pieces of this whole puzzle is we're seeing the highest supply or new deliveries, basically new construction of apartments is at the highest it's been in the last 50 years in a lot of markets. And so that supply, what does it do? It ultimately reduces rents at the apartment level because now there's more supply. So, unless there's stronger demand to offset that, you're going to have some weakness in rents. So, weakness in rents ultimately flows down into the valuations of a property and creates more weaker cash flow and ultimately can lead to lower occupancy, which is also kind of an impact there. So, you've got a lot of supply coming online in some of these Sunbelt markets because they are just have historically been a little bit easier to develop in as well. And the growth has been so strong, it made a lot of sense for the developers. So, we think that we're going to find some good opportunities in those markets that are, again, going to have to battle through some of the near term challenges of new supply combined with challenges on kind of expense inflation's ongoing. But over the long term, population demographics, job growth has continued to be very strong, and the demand side of the equation has actually been a little bit stronger than folks thought it would be relative to the new supply that's coming online. So, I think if we could acquire, 3 to 4 properties in 2024 in kind of some of these target markets, like that would be a solid year. We are a little bit more conservative as far as kind of underwriting assumptions, which again made it so we hadn't purchased a deal in quite a while, and makes it a little bit difficult to find the deal that makes sense. But I think we are going to be able to again responsibly grow our portfolio over the next 12 to 18 months, and longer term, I think we're going to be in a great place to continue to grow it. I mean, one of the things about our current portfolio is it's roughly 100 million in size currently. We're in very good shape as far as the basis and the cash flow of the current portfolio, which there's a lot of potential for sellers that are out there that a lot of people are waiting for to kind of push the market down further. And we're seeing that in underwriting. Like I underwrite deals that have significantly negative cash flow, and these folks are likely in trouble and likely going to have to sell at a loss to
Mm-hmm.
where they bought it. But it hasn't quite happened at a widespread level yet. So opportunity wise, I think there's going to be a lot of opportunity for those who are kind of willing and able to capitalize on it. And I think over a longer term horizon that Vanamor will continue to stay in our middle market focus, look to acquire at a reasonable pace on an annual basis. And I think we are very investor focused. So our investors are the highest priority, with kind of transparency and communication, and making sure that they get everything that they need from us.
Awesome. So Evan, this is a podcast about success, but if you ask anybody on the side of the road, how do you define success? You're going to get a different answer from each person based on who they are in their life. So for you personally, how would you define success?
I'm playing the long game as far as real estate financial success. We are investing alongside in each of these deals that we're acquiring, and really the reward is not 1 to 2 years; it's generally 5 to 7 years down the road. So personally, I'm looking to kind of grow my real estate portfolio responsibly over the coming 3 to 5 years. Another area that I like to highlight as success is, again, I just kind of mentioned the importance of investors in our process is if you can go out and reach out to our investors and have a conversation with them, and they say, oh, I've had a great experience at Vanamor, everyone on the team has been very professional and helpful, and the communications and reporting and all that has been great. To me, that's success as
Mm,
well. If those folks can report back in a positive nature, then I know that I'm doing my job, and the rest of the team is doing our job as far as kind of doing what we set out to do from growing a real estate portfolio perspective.
it's awesome. Well, Evan, thank you so much for being here today. This has been an awesome conversation. Where can listeners find you guys if they want to reach out?
Yeah, we have so you can go to vanamor.com. So that's VANAMOR.com. And we put out a monthly newsletter where we talk about market trends and things that we think are interesting in the multifamily space. So you can subscribe to that there. You can find my contact information as well. Feel free to shoot me a note directly. Would love to chat with anybody who's interested about kind of the market opportunity and what we're seeing. If helpful. So feel free to reach out there. I'm also on LinkedIn. You can just search Evan Curtis. I don't think there's too many, so you should be able to find me there.
And we'll tag all those in the show notes as well. So, all right, thanks for being here today.
Thanks, Leland.
Just making sure it stops. For some reason, it's still recording. Stop.